All right, so today we're tackling something that I know is on a lot of people's minds out there, especially if you're in the UK and own property.
Right.
And we wouldn't be having this conversation without the great folks over at ProTax Accountant. Um, they're really leading the way, I think, when it comes to helping people understand and navigate all the ins and outs of taxes in the UK.
Yeah, absolutely.
And I think we all know that inheritance tax can be a bit of a big concern,
For sure.
especially when you're talking about estates with, substantial property involved.
Hmm.
So today we're really laser focused in on this. How can UK taxpayers, like yourselves, deal with these inheritance tax obligations without having to resort to selling property?
Exactly.
Right. We've pulled together all the latest guidance from gov.uk and HMRC. Everything's up to date as of March 2025.
Right.
So, we're giving you the most current information to help you understand your options.
Absolutely. Inheritance tax, or IHT, the acronym you'll often see.
Yeah.
It's essentially a tax on the value of everything someone owns when they pass away.
Yeah.
That's their property, money, possessions, you name it. It's all part of the estate.
Right. So who's actually responsible for paying this tax?
Good question. So the legal responsibility falls on the executor or the administrator of the estate, and they use funds from the estate itself to cover the tax bill.
Got it. So the beneficiaries, those inheriting the assets, they're not the ones directly paying out of pocket.
Exactly.
Okay, that's good to know.
Yeah.
So let's talk numbers. What are the thresholds we need to be aware of here?
Well, the standard threshold, what we call the nil rate band, is currently set at £325,000.
Okay.
Now, if the total value of the estate is below that, then you're typically in the clear, no inheritance taxes due.
Nice. So under that amount, you're good.
You're good.
Okay.
But even if you go over that threshold, there are certain assets that are exempt.
Oh, okay. Like what?
Well, anything left to a spouse or civil partner,
Makes sense.
or a registered charity, or even a community amateur sports club.
Oh, that's good to know. So those are completely exempt.
Absolutely no IHT on those.
Right. And what about when you're specifically passing down a home to like your kids or grandkids?
Ah, yes. That's where the residence nil rate band, or RNRB, comes in.
RNRB. Okay.
That can really bump up that tax-free amount.
So how does that work?
Well, if you leave your home to direct descendants, and that includes children, grandchildren, adopted foster stepchildren, the whole lot,
Okay.
the total tax-free threshold could go as high as £500,000.
That's a pretty significant jump.
It is, especially for families who want to keep that family home within the family.
Yeah, that's a big deal. And for couples, it gets even better, right?
You got it. Any unused portion of both the nil rate band and the RNRB can often be transferred to a surviving spouse or civil partner.
So you can kind of stack those together.
Exactly. So you can imagine for couples passing a home down to their kids or grandkids, they could potentially reach a combined tax-free amount of £1 million.
Wow. £1 million tax-free. That's a lot.
It's a huge help.
Yeah, that's amazing. Okay, so let's say your estate does end up exceeding those thresholds. What's the tax rate then?
Well, the standard IHT rate is 40%.
40%.
But, and this is important, this is only applied to the portion of the estate that goes over those tax-free thresholds.
Right, so it's not the whole value of the estate.
Exactly. Right. So let's say you have an estate worth £500,000.
Okay.
And let's say, for simplicity's sake, only the standard nil rate band of £325,000 applies.
Okay.
That means you're left with £175,000 that's actually taxable.
Got it.
And at 40%, that would come out to an inheritance tax bill of £70,000.
Okay, that makes sense. So are there any situations where maybe you get a lower tax rate?
Yes, there is. If you leave at least 10% of your estate's net value to charity.
Oh.
And by net value, we mean the total value minus any debts like mortgages, loans, things like that.
Yeah.
So if you do that charitable, giving the IHT rate on the rest of the taxable portion goes down from 40% to 36%.
Okay, so a little bit of a break there if you're charitably inclined.
Exactly.
All right, so when does this tax actually need to be paid?
The deadline is 6 months after the date of death.
6 months.
It's crucial to meet that deadline.
Yeah, I bet.
Because HMRC starts charging interest on late payments. And that interest rate, it currently sits at about 7.25%.
Oh, wow. So you don't want to mess around with that.
Not at all. Plus, you can even face penalties if you delay too long.
Right, so that 6-month deadline is serious business.
Very serious.
Okay, so we've got the basics down now.
Yeah.
But let's get to the heart of the matter here. How can you actually pay this tax, especially if you don't want to sell the property?
Right. Well, one of the easiest ways, if you have the means, is to use any liquid assets already in the estate.
Okay, so like cash in the bank.
Exactly.
Mhm.
Savings accounts, investments that are easy to access, anything that can be quickly converted to cash.
Yeah.
If you have enough of that, you can cover the entire IHT bill without even thinking about selling property.
Okay, and I assume that's the ideal scenario for most people.
Absolutely. It's the simplest way.
Right. But what if you don't have that kind of cash readily available?
Well, then you might consider borrowing against the property itself.
Oh, so you're talking about like a loan.
Exactly. A loan secured against the inherited property.
So you're basically taking out a mortgage on a place you just inherited to pay the tax on it.
In a way, yes. It's often called an IHT loan.
IHT loan, okay.
And it allows you to keep the property while managing the tax burden through regular loan repayments.
Okay, and what kind of interest rates are we looking at there?
Typically, they range from about 4% to 6% currently,
All right, so not insignificant, but
but manageable.
yeah. But another option we should definitely talk about is setting up an installment plan with HMRC.
Right. That's a really important one.
So tell me how that works.
HMRC gives you the option to spread out the IHT payments on certain assets like property over a period of up to 10 years.
10 years.
That's a long time.
It is. And here's the best part. There's no interest at all for that first year.
Really? No interest for a whole year?
Nope. After that year, though, interest does kick in.
At what rate? Currently, it's the same 7.25% we talked about earlier.
All right.
But to be eligible for this, you'll need to demonstrate to HMRC that the estate doesn't have enough liquid assets to pay the tax all at once.
So you have to prove that you really can't pay it up front.
Exactly. And this can be a real lifesaver for estates where selling the property would be the only option otherwise.
Yeah, that makes sense.
Yeah.
Okay, so what about being proactive here? Are there any steps someone can take now to prepare for these potential IHT liabilities down the road?
Life insurance can be a huge help here.
Okay, life insurance. How so?
If the deceased had a life insurance policy, ideally one written in trust,
In trust. Okay.
the payout from that policy can be used to directly cover the IHT bill.
Makes sense. And what's the advantage of that trust setup?
Well, the payout usually doesn't become part of the taxable estate itself.
Oh, so you avoid that extra layer of IHT.
You got it.
Yeah.
It can really make a difference. And setting up a discretionary trust offers flexibility in how the money's distributed.
Okay, so that's something to really look into.
Sure. Now, for beneficiaries themselves.
Okay, so if you're the one inheriting the property,
Exactly.
what are your options?
If you plan to live in the inherited property, you could look into equity release.
Equity release.
Yeah.
Remind me what that is again.
It basically lets you access some of the value that's tied up in your home.
Okay.
You usually get it as a tax-free lump sum.
So you could use that to pay the IHT.
You could, but it's really important to understand that with equity release, interest usually starts building up right away.
So the debt can grow over time.
Exactly. It's not a free lunch.
Yeah, got it.
So,
So you really got to weigh the pros and cons there.
for sure.
Now, for our business owners out there, I hear there might be some specific breaks for you guys.
That's right. Business property relief, or BPR.
BPR. Oh.
It can offer some really significant tax advantages.
How so?
It can provide either 50% or even 100% relief from IHT on assets that are used in a trading business.
So not like investment properties or anything.
Right. It has to be an active trading business. And you generally need to have owned those business assets for at least 2 years before death to qualify.
So it's not a last-minute loophole or anything like that.
Nope. You got to be in it for the long haul.
All right, so are there any big changes coming up with BPR that people should know about?
There is actually a pretty important one. From April 2026, BPR, when combined with agricultural property relief, or APR, will have a cap of £1 million.
£1 million cap.
Please.
So what happens after that?
For any relief you claim above that million, the BPR rate drops to 50%.
Okay, so it's not like you lose it completely, but...
No, but it's definitely something to factor into your planning.
Right, especially for larger businesses.
Absolutely.
Okay, so just a couple of final thoughts for taxpayers dealing with IHT. What else should we touch on?
Well, if you end up overpaying IHT, you can actually claim a refund from HMRC.
Oh, that's good to know. How would that happen?
It could be something like a later valuation of assets that comes in lower than initially thought.
Okay, so you paid more than you actually owed.
Exactly.
Yeah.
And they'll typically repay that overpayment with interest.
And what's the interest rate on that?
Currently around 2.75%.
Okay, so not a bad deal if you're getting money back.
Not bad at all.
All right, and anything else we should mention?
Just one more thing. If you inherit a rental property,
Oh yeah, that's common.
that rental income is going to have pay-why implications for income tax.
So you got to factor that in.
Absolutely. HMRC has some online tools and tax checkers that can help you figure all that out.
Great, so you can kind of run the numbers and see where you stand.
Exactly.
Well, I think this has been a really helpful overview for anyone out there trying to understand how to handle inheritance tax without necessarily selling property.
We've covered a lot of ground.
We really have. From using liquid assets to exploring loans, HMRC installment plans, life insurance equity release, and business property relief.
Yeah, lots of options to consider.
And it's important to remember that all of this is based on the current rules as of March 2025.
Right, things can always change.
So it's really crucial to get personalized advice for your own unique situation. And for that, I can't recommend the folks at ProTax Accountant enough. They really know their stuff.
They're the experts.
Now, if you're looking for some guidance on navigating all of this, definitely reach out to them.
You won't regret it.
All right, well, thanks for breaking all this down for us.
My pleasure.
And to all of you listening out there, thanks for tuning in.